Well, hello and welcome back to Principles of Accounting 2. I'm your host, Dr. B. Today we're going to be talking about a very important concept in business, and that is break even. Break even. Understanding at what point do we hit break even. And we analyze the point of break even through this concept called cost, volume, profit analysis. That's a fancy term for saying break even. It's understanding the cost of manufacturing, which, as you remember, is direct materials, direct labor. In fact, that's the cost. We know the cost of manufacturing a product. Now that we know the cost of manufacturing a product, we need to understand the volume. The volume is how much of this product that I know the cost for to manufacture. It's how much do I need to manufacture? The volume. Volume. Kind of like the volume on my microphone for some reason. Yep. Uh, the volume is how much I need to manufacture. And I need to know the point at which I start making a profit. We call that break even. How much of this stuff, this product, do I need to manufacture in order to break even? Cost, volume, profit analysis. That's what this is all about. And before we jump into today's discussion on cost, volume, profit analysis, I am going to jump into the classroom and show you where we are, where we're heading, because it is important that we understand where we're heading with respect to the course. Hopefully that adjusts. Uh, and where we're going. So in the classroom, we are currently sitting in week 6. Module 2, week 6. Chapter 21, that's what we're about to go over. What does that mean for you? Well, we started off week 2. Week 2 with the chapter 17 discussion. We went through chapter 17, then 18, then 19, then 20 last week. Now we're doing 21. So, what does that mean? In about a week and a half, roughly, you'll have your midterm exam. The midterm exam will cover chapters 17, 18, 19, 20, 21. Basically everything we've covered in this class so far. The midterm exam has some weight to it, as you know. It is, I'm just going to take a quick look at the settings here. It's worth 20 points. A mix of true, false, multiple choice. It's designed very similarly to your homework assignments. 20 questions, true, false, multiple choice. It's worth 20% of your total grade. Ooh, I know that's a lot. So, what that means for you is over the next week or so, you should be reviewing chapters 17, 18, 19, 20, and 21. And in that review, you should be doing the following things. Reviewing the presentations, the videos, reviewing the PowerPoint slides, but most importantly, reviewing your previous homework and quizzes. Because that midterm exam is going to be very similar to the questions you've had on your homeworks and quizzes. That's a pretty big hint there, if I'm not mistaken. So having said all that, next week we'll do a review for the midterm exam, a quick study, and then you'll take the midterm exam the following week. The university hasn't given me the date yet for it, but as soon as we get a date, that's when we'll be done by. It's open and available for you to review right now. So if you want to look at those questions, go ahead and do that. Any questions on that? Questions at all?
No.
We're good. Mr. Tinsley says my microphone is breaking up. Is that true? The rest of you?
It just sounds like you're far away from the mic.
Far away? Yeah, I can't fix that, Mr. Tinsley. I have no idea how to fix that. It's weird. Is anyone else experiencing that same issue?
Yeah, that's what I was noting at. Is your volume all the way up? Because I turned mine all the way up. Because you are one professor that I will say are very clear and very articulate. But today, you just sound far away and a little muffled.
Weird. Yeah, I'm like right on top of the microphone. So, oh man, what a pain. This technology, I tell you what, it drives me nuts sometimes. Let's see if we can't try to fix it in this darn WebEx nonsense with their updates, which I'm sure is why it's messed up. Thank you, WebEx, for screwing things up for us as usual. Let's see if I can't do this. Adjust automatically. Is this better? Better, worse, the same?
I say it's a little better.
It's a little better.
It's a little better. Okay, I cranked the volume all the way up in the settings. And apparently it automatically adjusts, so that could be part of it.
Yeah, that's a lot better. We can
A
hear
lot
you.
better? Okay, fantastic. Thank you so much. Appreciate your patience. Sometimes this technology, you know how it is. It drives me crazy too. That's why sometimes it'll be nice to be face to face once in a while. But you know how things are, so here we are. Thank you for your patience. I appreciate that, and thank you, Mr. Tinsley, for bringing that to my attention. Hopefully it's a little bit more clear for you now.
No problem, Professor. You sound a little bit better now. So
Okay, great. Okay, yeah, just do your best and let me know if it breaks up again, so I can hopefully try to fix it. But thank you. Okay, without further ado, I'm sorry for the brief interruption with the microphone thing. Let's go ahead and jump into our conversation on break-even, also known as cost, volume, profit analysis. Again, fancy term for break-even. We're going to talk about the cost of manufacturing a product, which, as you recall from our previous discussions, previous lectures, is direct materials, direct labor, and factory overhead. In addition to those costs, we're going to discuss how many units, how many pieces of the finished goods I need to make in order to break even. Call that volume. How many of these things do I need to create to break even? That's the volume part we're going to talk about. Okay. And then profit analysis, the profit part is how many of these things do I need to sell in order to break even and make a profit? Yeah? So that part of the discussion will be great. I am, however, going to bore you a little bit with statistics. Okay, don't freak out because I know statistics is hard. I didn't like statistics when I was a student. I thought it was terrible. Okay? I was a bad student when it came to statistics. That was not a subject for me. I didn't like statistics. I still don't like statistics. So, uh, the statistics part I'm going to talk about today, we're going to go through and just get a baseline of it. We're not going to do a deep dive and regression analysis and all that jazz. That's not this kind of course. And I'm not that kind of guy. So, we'll talk about statistics from the perspective of cost, how many units I need to make, how to break even. But that's going to be it. We're not going to do a deep dive in statistics. So I just want to preface that because I know a lot of you said, oh, Dr. B, this chapter is a lot about statistics. I see this thing called regression analysis. What's that? Don't worry about that. Okay, we'll talk about it, but don't stress over the statistics part. Promise you, the statistics part's not going to be on the midterm. We're not going to talk about statistics that much. But I just want to put that out there in advance before you guys start freaking out saying, "Oh, I don't like statistics." Neither do I. It's okay. So we'll get through it. So the first thing we need to talk about again is cost. We know that the cost of manufacturing involves direct materials, direct labor, factory overhead. We know that those three things together equal the total cost of manufacturing a product. We talked about that past couple of weeks. Now that we understand that, all the costs involved, there's a couple of components to those costs that we need to identify in order to understand how many units we need to sell to break even. We need to understand the cost because we also need to know how much income must increase or will increase if we install like a new machine to reduce labor costs. We think about things like, what if there's a change in the income if my sales price decreases and my sales volume increases? In other words, what happens if I put it on sale? If I put it on sale, I reduce the price, sales price. If I reduce the sales price, will I sell more? Hopefully. We think about questions like, will my income change if we change this, uh, if we change the sales mix of our products or services? In other words, if I go from just selling this one product and I add other products or services, how will my income be affected? And we also think about things like, how many units do I need to sell to earn what's called a target income? Target income is like, that's how much I want to make. That's how much income I want to make. That's, we call that target income. These are all behaviors, cost behaviors. In finance and accounting, the numbers are a result of behaviors, not human, well, to some degree, human behavior. To some degree, human behavior. Human behavior tells us that if something goes on sale, meaning the sales price is reduced temporarily, there's a great chance I'll buy more of it. And we know that's true. Like, if I go to the grocery store and I see, oh, you know what, that Hershey's chocolate bar I like so much, Well, right now it's on sale, 2 for $1. There's a good chance I'm going to buy 2, right? It's a good sale. You can't beat that kind of sale. So that's human behavior. Pricing is all behavioral for the most part. When I price a product, I price it strategically. Think about like the last time you went to a place like Walmart or Target or the grocery store or wherever you went. You don't see a sales price that says $3. It says $2.99. There is a psychological reason why it says $2.99 and not $3. The reason is the human mind is triggered into thinking, oh, I'm getting a deal. It's $2.99, not $3. That's the psychological reason why we see sales prices marked as $2.99 instead of $3 even at the store. It's behavioral. It triggers the thought process of, I'm going to buy more because it is perceived as costing me less. The sales price is perceived as being lower. Just buy that 1 penny, right? Man, these marketing people are smart. They're real smart. But yeah, that's how it works. Cost is behavior. Cost is also behavioral based on manufacturing. Cost, total cost, might decrease, usually do decrease, with the more that I make, the more units I'm making. Let me explain that. Here we're looking at fixed costs. Fixed costs, as you remember from our previous discussions, are costs that remain the same over time. They're fixed. Example of that would be supervisor's salary. Example of that would be rent. An example of that would be depreciation. But these are fixed costs. They do not change, regardless of the level of output. Fixed cost stays the same. What does change are the variable costs. Variable costs, as you recall, are costs that change based on the level of output, level of production. Variable costs, level of activity. Variable costs change with the level of activity. The more units I produce, the higher my variable costs are. My fixed costs remain the same. So if we take a look at this top chart here, the one on the top, center of this slide, we have fixed costs that do not change regardless of activity. And we have variable costs that do change with the level of activity. The more we manufacture, the higher my variable costs are. My fixed costs remain the same. So, taking a look at this example, my fixed cost for the month is $32,000. That's my fixed cost. I got to pay that $32,000 every month, regardless of how many units I produce. That includes things like my rent, salaries, etc. Things that do not change over time. Fixed cost, $32,000. My variable costs are $20 per unit. Remember, variable costs, direct materials, direct labor, some factory overhead. Those variable costs. They're variable because my direct materials cost rises with the more units I produce. My direct labor cost rises with the more materials I produce. Some factory overhead rises with the more that I produce. So my variable costs are $20 per unit. So I got $20 per unit. I got $32,000 of fixed cost per month. So my total costs are $32,000 plus, so fixed cost plus the cost per unit. The more I manufacture, the more cost per unit I'm going to have. That's what this first graph represents. It's the relation of the total fixed cost to the total variable cost as volume increases. We can see the three colors, right? Well, hopefully none of you are colorblind. So this top one here, this green one, the green line, that represents the total cost per unit. Remember, total cost is fixed plus variable cost. Total cost. The I don't know what color that is. Burnt orange? No, the light orange. Light orange? Is that right? I don't know. This light orange color over here that's rising, 0 to whatever this is. We see that rising. That is our variable cost per unit line. Variable cost. And this solid orange, dark orange color, the one going straight across, that's our fixed cost. So we have fixed cost plus variable cost rising. Well, the fixed cost stay the same. The variable cost rises based on the level of units being produced, the volume. Okay. So we can see that the total cost, fixed plus variable, rises with the increasing volume because we're taking our fixed cost plus our variable cost per unit. Makes sense so far?
So far, so good.
Awesome. Thank you very much.
Yes, well understandable.
All right. Fantastic. Thank you so much. So we got that part down. The next thing I'm going to show you down here on the bottom of the slide here, the next chart, graph, whatever you want to call it. We have based on per unit. So up here at the top, that's total cost. Down here at the bottom, it's the relation of per unit cost. Because remember, the cost of manufacturing one unit involves variable cost, direct materials, direct labor, fixed cost, direct labor, factory overhead. Remember, we call it conversion cost. Equal total cost per unit. Now let me show you this relationship. So per unit fixed cost and per unit variable cost based on production volume. Remember, production volume, as we move to the right of this graph, the volume is increasing. We see a very interesting relationship here. If variable costs are the same per unit, $20 per unit, okay? So variable costs are $20 per unit. That's our direct material, direct labor. $20 per unit. We can see that with the increasing level of production, based on a per unit basis, my fixed cost per unit decreases with the additional units produced. Now here's why that happens. Here's why that happens. If my fixed costs are $32,000 and I'm producing certain volumes of units, I take my fixed cost, and I'm dividing that by the number of units produced to get a fixed cost per unit. That's how we allocate our fixed cost to each unit, right? Fixed cost per unit is total fixed cost divided by the number of units produced. That is why we see our fixed cost per unit decreasing with the additional units being produced. This also means that my total cost per unit, which is fixed cost per unit plus variable cost per unit, is also decreasing with the additional units being produced. Do you see the relationship? Does it make sense?
Did that skip on anybody, or was that just my computer?
I don't know.
It didn't skip for me.
No, it didn't skip
Okay,
either.
I'm sorry, Professor.
That's okay. Hey,
Could you repeat that? You were saying the fixed cost. How do you find the fixed cost per unit? Because it literally just stuck like a old CD, old scratch CD.
that's okay. Yeah, you know how the technology gets. Okay, so the fixed cost per unit, we take total fixed, I'm sorry, my handwriting is so bad. Total fixed cost, it's a T. Total fixed cost divided by the number this is what you would get if we were in the classroom. Number of units the volume. Number of units produced. So total fixed cost divided by the number of units produced, that gives us our fixed costs per unit.
Thank you, Professor.
You're very welcome. So, having said that, we see that the more units I produce, the lower my fixed costs are per unit. That makes sense. So I take the $32,000, I divide it by the number of units I'm producing. If I produce 2,000 units, my fixed cost per unit is going to be, what, 18 bucks? So we see how low it gets with the more units I'm producing. So because my fixed cost per unit are decreasing over the volume being produced, we see that my total cost per unit is also decreasing. Because remember, total cost per unit is fixed cost per unit plus variable cost per unit. Mr. Rhodes.
Okay, yeah, that's what I was gonna ask. Okay, so that means that the more units that you make, the lower that the lower the fixed cost.
That's right. So, but it's the fixed cost per unit.
Yeah, that's what I'm saying per unit.
Yeah. So the more units I produce, the lower my fixed cost per unit it is.
Okay.
Because what I'm doing, Ms. Rhodes, is I'm taking that $32,000 of fixed cost for the month, and I'm
Mm-hmm.
applying that to the units that I'm producing.
Okay.
You good?
Okay.
We got it?
Yes.
Cool. Awesome. Thank you so much. And so we see the relationship with the number of units I'm producing. The more I produce, the lower my fixed cost per unit are. My variable cost per unit stays the same. Now, the reason why the variable cost per unit stays the same is because it cost me $20 of direct materials and direct labor to create a single unit. And that's going to be the same. I got labor, I got materials. Stays the same for each unit. But, as we saw earlier on the one above, the more units I produce, the higher that total variable cost is. So yeah, we're getting there. This is good. This is very good. Now let's look at variable cost. That was fixed cost we just saw. Now let's look at variable cost. Very similar relationship. Okay? Very similar relationship. If you flip between these two slides, you think we were at the eye doctor's office, right? I mean, it's like, oh, which one looks better? Which one looks better? Right? Sorry, I didn't mean to play with your eyes like that. But let's look at the variable cost. We see that the variable cost per unit rises with the amount of units being produced in relationship to the total fixed cost. That's what we're looking at the top, yes? And then on a per unit basis, oh, I know it cost me $20 per unit to make with the direct materials, direct labor, so that stays the same. The fixed cost is what's coming down, and the total cost. That's the relationship of fixed and variable cost with respect to changes in the level of output, the number, which is the number of units I'm producing. So just remember, the one on the top shows us the total cost. The one on the bottom shows us the per unit cost. Now I'm going to introduce mixed cost. Mixed, M-I-X-E-D, mixed. Mixed cost. Mixed costs are a bit of a pain to understand, so I'll do my best. Mixed costs involve fixed plus variable components. Mixed. What it means. We talked about this briefly a few weeks ago. We talked about mixed costs. And I think I gave an example of renting like a copier machine, or rent plus some additional overhead. Let's use the example of the copier machine. So UDC rents copier machines from Xerox, okay? Which I think they still do. So UDC rents copier machines from Xerox. There's an allowance of 50,000 pages that we can print per month. And the cost for that is a fixed cost. It's like $1,000 for the month, okay? If I go over the 50,000 page allowance for that month, now I have to start paying on a per page basis. So it's like, oh, you reached your limit on the amount of pages you can print, so now we'll charge you overage, right? It's kind of like your cell phone data plan. Once you hit the certain gigabytes for the month, then you have to start paying an additional per usage basis, right? It's the same concept. So that's what makes it a mixed cost. There's a fixed component. In the copier example, it's $1,000 for the month, and a variable component. But when I go over the 50,000 page allowance, now all of a sudden I'm being charged on a per page basis. Make sense? That's mixed costs. Mixed. A little bit of fixed, a little bit of variable.
Can you explain it one more time?
Sure, you got it, Kayla. No problem. Okay, so here's how it works. Mixed cost is the combination of both fixed and variable cost components. And I'm going to use a copier machine as an example. UDC rents copiers, the copying machines, the things we use to print. We rent those from Xerox at a cost of $1,000 per month. Now, Xerox tells us that, hey, you pay me $1,000 per month, and you have an allowance of printing 50,000 pages per month. Once you go over that 50,000 page per month allowance, then we'll charge you 1 penny per page. The fixed cost of that is the $1,000. They're going to charge me that $1,000 every month, regardless of how much I'm printing. So it's a fixed cost. But when I print over the 50,000 pages, now all of a sudden I have to pay them an additional penny per page over that 50,000. And then it resets at the end of the month. It's just like your cell phone data plan. Once you hit a certain gigabytes per month, once you go over that, they charge you an additional something dollars for another gigabyte or whatever. The fixed cost part is the limit. Anything over that is variable cost. Does it make sense now?
Yes, sir.
Awesome. Very cool. So it's just a matter of thinking about what part is fixed and what part is variable. And with a mixed cost, it's both fixed plus variable.
And variables, they can change, right?
Variable is what changes, exactly. That's what changes based on the level of output. So like this orange line here on the top graph, we see that going up. That's our variable cost per unit in a relationship to total cost. So I know that $20 per unit, the more units I produce, the more my total variable costs are. Yeah, that's exactly right. Great question. Okay. This next one, this is where it gets confusing, okay? So stick with me. We don't use this much in real life, but I will give you some real life examples because sometimes it does work that way. Your cell phone plan might have this thing where you use, let's say you have in your plan, it's unlimited text messages and talking, all that jazz. And they give you the gigabytes, right? The data. The data says you get 3 gigabytes of data each month. Okay? And you also have unlimited talk and text, whatever. We call that the base. We call that the base. Okay, so right down here. This is where you would be, the base. When you hit that 3 gigabyte limit, the cell phone company says, hey, I'll charge you an additional $20 for that next gigabyte that you can use. We call that a stepwise cost. It goes up in steps, right? 3 gigabytes, you use it, and you go up to 5 gigabytes. You end up using those other 2, then you're up to 7. Okay? It's based on steps. That's what they call stepwise cost. it doesn't happen a whole lot in manufacturing. It happens more in terms of like usage cases, like the cell phone situation. This other one's weird, okay? This is called curvilinear cost. Curvilinear cost is like it's like a wave. It's kind of like a wave. Curvilinear cost. It has curves in the line. You know? And what this does is it shows us how costs increase based on the levels of production when there's plateaus. Like in other words, up to this amount of units produced, then I have to add something, and so it raises the cost up until this number units level units of production, then I have to add something, the cost goes up. It's similar with this curvilinear cost. It shows us that with new higher costs, the next it goes in steps, right? Ranges, if you will. It's like, oh, I produced 600 units. The next 600 units will cost me a little bit more. The next 600 units will cost me a little bit more. There's a couple of usage studies around this, but I just want you to understand what it looks like. With the curvilinear part, the costs increase when activity increases, but in what they call a nonlinear manner. It's like a wave, okay? Because it's based on the steps. It's like a wave. It plateaus, it increases, it plateaus, it increases. Okay, here we go. This part is so boring and useless. I'm just putting that out there, all right? This is the statistics. Statistics. I know statistics. Dr. B, this isn't a statistics class. This is an accounting class. I know. Statistics has some value when it comes to cost, which is why we talk about this. I'm not going to dive too deep into the scatter diagram or in regression analysis. That's too ridiculous stuff for accounting. What is going to be important, though, from this part of the conversation is the high-low points and the, that's probably the only one I care about out of these three. So let's talk about the three methods for classifying cost: scatter diagram, high-low method, regression. The only one that I think is somewhat important is the high-low method. And the reason for that is because it helps us to see the differences in each month with respect to fixed and variable costs, how they change in each month. And that way we can get an average in order to estimate production in the future. That's why I think the high-low method is important. The other two, nice to know, but not super important. Here's a scatter diagram. For those of you who have taken a class on statistics already, you've probably seen this at some point, hopefully. If not, this is new news for you. I'll do my best to explain it. Okay, so with a scatter diagram, it shows us the points at which each month is represented along a line. Call it a scatter diagram. Each point, each little green dot there, represents a single month. So this guy over here is probably January. Here's March. Yeah? Here's some other month. I don't know. I'm just going along. We'll pretend that the follows a calendar. But we see each little green dot represents a month. And that green dot intersects somewhere. We see that March we had $25,000 in total cost for the month of March, and it looks like we produced probably about 25,000 units. So $25,000 in cost, 25,000 units. My estimated fixed cost is $17,000. Remember, fixed costs do not change regardless of the level of output. If I was doing this on a per unit basis, it would look different, of course. But the fixed cost does not change regardless of the level of output. Based on this scatter diagram, I can estimate, just looking at it, I can estimate my line of cost behavior. In other words, I can estimate my variable cost, where it's going to be in relationship to what actually happened in each month. That's the purpose of looking at something like a scatter diagram, is to estimate cost from a graphic perspective. Now again, don't read too much into this. It's not as important as some of these other methods. Still, it has importance, but it's not as important. This method, right here, this one, the high-low method, I personally feel is the most useful when it comes to observing and estimating cost. Because I can project using these numbers. This is to me, this is probably like the most important method out of the three for estimating cost. And the reason why is because it helps me to predict what is going to be produced in each month. So I can plan for that month in advance. It's like, okay, so last year I had these data points, so therefore I can budget and plan for the next year using these data points. That's why I like the high-low method, because it tells me what months did I produce the most, what months did I produce the least. And we can see the relevance in total cost during those months. So here we go, here's some data. We got January through December. So take a look at this information. Who can tell me which month was the highest in terms of number of units produced? Number of units produced, which month was the highest?
November.
November, 67,500, yes. So November had the highest number of units produced. November also looks like the highest total cost, right? 31,000. Yeah, 31,000, highest total cost, highest number of units produced. That's probably my high month, is November. Now who can tell me which month had the lowest number of units produced?
June?
June, that's correct. So June was the lowest number of units produced, 17,500. And I had a cost in June of 18,500. Okay, so now I know what the high is November. The low is June. Now we use a couple pieces of information. We look at variable cost per unit and total fixed cost. Now let me show you what we do with this information. So we said the high was November, 67,500 units at a total cost of 31,000. My low was June, 17,500 units, 18,500 total cost. The first thing I want to do is find the change. Change, of course, is the difference between the two. So the change, I take high minus low, high minus low. So high, November, 67,500, minus low, 70,500. So the change is 50,000, high minus low. 50,000 units is the difference, the change. The change in cost, high minus low, is 12,500. Now, I want to find the change in the cost per unit. Change in the cost per unit. So to find this, I take the change in cost, 12,500, divided by the change in units, 50,000. So cost, 12,500, divided by units by 50,000, gives me a change in the cost per unit of 25 cents. 25 cents per unit change in the cost per unit. Now, the reason why that is important is because it will represent a change in the total cost. Now, let's find total cost. I find total cost 31,000 at the high. The high, 31,000 equals fix the cost. We're going to find fixed cost, right? Find the fixed cost. 31,000 equals a fixed cost. Remember, we're looking for fixed cost. Plus variable cost per unit change, 25 cents. 25 cents per unit change times high number of units, 67,500. That gives me a total variable cost change of 16,875. Now, if I switch signs, remember order of operations. So I'm going to take that 16,875. I'm going to subtract it from my total cost to find the fixed cost. Because remember, we're trying to find fixed cost. How do you find fixed cost? Take total cost minus variable cost. 31,000 total cost minus variable cost 16,875 means that my fixed cost is 14,125. We all see how we got there, right?
Yes.
Awesome, thank you. Sometimes it's the switching the sign. Sometimes that's the part that's confusing.
So you sort of made it a little bit more simpler, even though I had already figured that part, because what we're doing now is what I'm doing in my hospitality costing class. We're doing food costs now,
Oh, okay.
and we
Yep.
pretty much, yeah. So
Yeah.
we doing a little bit of this.
You know, I keep telling Professor King I want to teach that class because everything that you'll learn in that cost class for hospitality is very similar to what we do. It's all the same principles, really, and so that's what makes it fun.
Yes, because I noticed that when you started talking about the variable costs and fixed costs, I said, wait a minute, I did this already. Well, let me go look back. And it was it was in my house, the hotel cost and food cost class, yes.
Yep, yep. I know that class well. I helped develop that one. So yeah, that's a fun class. Cool. That's great. So yes, the total fixed cost is 14,125 plus 25 cents per unit produced to get the total cost change. Total cost change. That's the high-low method. That's what the high-low method is all about. So, helps to find the average, really. It's just a long way of going about it. The change in that. Yeah, high-low method. It's a good one. It's a good one. Now for the pain. Regression analysis. Regression. Statistics. I know regression statistics. We do use this in advanced cost accounting courses. For those of you who are accounting majors and you're thinking about going on to get that bachelor's in accounting, there's a good chance you'll run into regression analysis in your advanced cost accounting course. We use spreadsheets and calculators and all that jazz to find regression analysis. I know, it's a pain. I want to show you like the very basics of it, okay? So don't worry too much about regression. It's not a regression analysis. It's not something we're going to dive deep into, but it's good to know. It's again not my favorite method. I like the high-low personally, but regression is still something we need to know. So we look at the ways to determine total fixed cost and variable cost per unit using regression analysis. That sounds like a pain. Yeah? You can compare after you do regression analysis, which we're not going to do. I'm not going to have you do that. But you can see there's a couple of differences based off each method that you use. For example, you can compare the high-low method to the regression analysis method. You'll find some differences in fixed cost and in variable cost. Regardless of the method that you use, the results will be similar. The results will either be similar or the same to some degree. So now we suffered through some statistics. Let's talk about the real reason why we're here talking about cost volume profit analysis. And that is to understand the concept of breaking even. And it all starts with identifying this thing called contribution margin. Contribution margin is basically finding like the gross profit per unit. Gross profit per unit. Contribution margin. Gross profit per unit. Contribution margin. It basically says, hey, we have the potential to make this much profit per unit. Contribution margin. To find the contribution margin per unit, we take the sales price per unit, that's how much I'm selling it for, minus the total variable cost per unit. That will give me the contribution margin per unit. So the sales price is $100 minus my variable cost per unit of $70. That gives me a contribution margin per unit of $30. It's not bad. It's actually pretty good, I think. It's a good contribution margin. You know, that's $30 per unit profit, basically. Yeah? Sales price minus variable cost. It shows that we're covering all of our variable costs. It's not, what it doesn't cover is the fixed cost. We haven't gotten to that part yet. I'll show you what that looks like soon. But sales price minus variable cost equals contribution margin per unit. That's a great formula, easy to use, and it helps us as managers to identify how much potential profit we can earn on each unit that we sell without taking into consideration fixed costs. So that's contribution margin per unit. The other part of this is I want you to understand the percentage. Percentage is important because it shows us the percentage of per unit profit, basically. So we take the contribution margin per unit that we got from the first step, so $30, contribution margin per unit, $30, 100 minus 70 is 30, divided by the sales price per unit. Sales price is 100. So 30 divided by 100 is 0.3. You multiply that by 100, and that's 30%. So 30% is my contribution margin ratio. Contribution margin ratio. It's 30%. So that tells me that about each unit I sell, I can earn 30% gross profit. It's pretty good. It's pretty good. Now that we know how to find the contribution margin per unit and the ratio, let's look at how many units I need to sell to break even. Break even is so important. You need to know how many units you need to sell to break even. Break even simply means that I'm not losing money, but I'm also not getting a profit. I'm breaking even. I'm covering all of my costs, and that's it. No profit, no loss. Break even is zero. Yeah? The point of zero, if you will. Break even. Point of zero. Yeah? It's where you're not making a profit, but you're also not losing money. It's the point of zero, called break even. It tells me how many units I need to sell in order to break even. It tells me how many sales dollars I need to sell to break even. So I can look at it in units or sales dollars. And there's three methods for figuring out the point of break even. There's a break even formula, simple to use, I promise. Break even formula is one method. Another method is called the contribution margin income statement. A little bit more complex. And then we also have the cost volume profit chart, little graphic. My favorite one's the formula because it's very straightforward. So here we go. Let's look at the formula. Break even. Remember, break even is the number of units or sales dollars that I need to sell in order to break even. Break even is the point of zero, right? I'm not making a profit, but I'm also not losing money. That's break even. So this formula will tell me the number of units I need to sell per month. It'll also tell me the amount of sales dollars I need to earn per month in order to break even. Break even, I'm covering my costs to the point where I'm not making a profit, but I'm also not losing money. So let's look at it first in terms of the number of units I need to sell to break even. This formula is very straightforward. It's the total fixed cost divided by the contribution margin per unit. My total fixed cost is $24,000. My contribution margin per unit is 30. Remember, contribution margin per unit is sales price per unit minus variable cost per unit. $100 sales price minus $70 variable cost per unit equals $30, which is the contribution margin per unit. Contribution margin per unit, again, sales price per unit minus variable cost per unit. So I had fixed cost, total fixed cost, $24,000, divided by contribution margin per unit of $30 equals 800 units per month. I need to sell 800 units per month to break even. See, it's a nice formula. It's very easy. Now I could also look at this in terms of sales dollars. How much money in terms of sales do I need to sell to break even? So I could do break even point in sales dollars. Very similar formula. I take my total fixed cost, $24,000, divided by the contribution margin ratio. Remember, the contribution margin ratio is when we take the contribution margin per unit divided by this sales price per unit. Contribution margin per unit divided by sales price per unit gives you the contribution margin ratio. So to find the break-even point in sales dollars, I take total fixed cost, $24,000, divided by 30%. 30% is written as 0.3. So 24,000 divided by 0.3 equals $80,000 of sales I need to make per month to break even. Make sense?
Yes, this is an easy, simple formula.
Great, thank you. Thank you. Yeah, I'm just trying to make it as understandable as possible because this is like the most important formula in business to understand. Because anytime you're looking to start a business or you're working with somebody or you're doing consulting for another company, a lot of times they don't know if they're breaking even. Okay? Because they didn't go to school. You know, they didn't take this class. Or maybe they went to school for, some other thing that they're doing. Yeah? So a lot of times they don't know these formulas, like the small business owners. They don't know these formulas. So that's why it's like this one is probably, in my opinion, like one of the most important ones to know. That's why I'm spending so much time.
Professor,
Yes, Kayla.
in a business, okay, so like, I don't want to say how do they know, like they're on the positive side of breaking even? What makes it good for a business to break even? Like,
Yeah, a lot of times they don't. so a lot of small business owners they think that they in their minds they think that, oh, I'm covering my costs, therefore I'm breaking even, or oh, I'm covering all my expenses, therefore I'm breaking even. It's not necessarily true, because if they don't know the point at which how many units they need to sell, or how much in terms of dollars they need to sell to cover their fixed costs, they're in trouble. Because they think that, oh, if I sell enough, I'll make some profit, right? That's what they think. And a lot of times they don't know to do this type of formula because oftentimes business owners, they didn't go to business classes, believe it or not. All the time I run into business owners that were doing something else. They were they were science majors, or they were um, uh, English majors, or they did something else with their life. Uh, so they start a business because they think that, I'll make a lot of money doing this. I really like doing this, um, but they don't think about all the costs involved with running the business. So it's that's why it's so important to know this formula and be able to explain this to someone that you're helping, or a business that you're in. And of course, hopefully they're tracking their costs. So then you can say, hey, you know what? These are the numbers we need to run to figure out how many units you need to sell, how much money you need to make in sales to break even. And that will change the business owner's perspective on what it is that they're doing. An example of that is recently I went to a farmer's market, and I was talking to a nice couple from Baltimore. They were selling a line of bath products. They were selling, like scrubs and soaps and all that wonderful stuff. And they're making it at their house, right? And they're going to these markets and they're selling it. I talked to them at length, about their business, try to understand their cost, try to understand their operation. And so I asked the question. I said, well, how many of these do you need to break even from this event? And they couldn't tell me. And I said, well, how much was the rent for the space? And how much was are you planning on paying yourselves? So, okay, so I got the fixed cost. And then I started running out, this formula. I said, okay, well, here's how many units you need to sell in order to break even from this event. And so it's things like that they don't think about.
So it's okay. To be clear, breaking even is not about showing the profit. It's about making sure that you're able to fully pay for your expenses,
That's
or
right.
can it show the profit?
Exactly right. Yeah, it's all about covering your costs. It's not about shooting for the highest profit.
Okay.
Yeah, excellent point. Great. Thank you for your question. Very good. Very good. So the contribution margin income statement method is the third method for understanding break even. This it's good. Okay, I like the method. It's all right. It's very easy to understand, but it doesn't tell us the whole picture. That's why my personal opinion again, is the formula method is absolutely the best method because it shows us in a very simple way how many units you need to sell, how much sales dollars you need to make to break it. Very easy. So this next method is called the contribution margin income statement method. And what it shows us is, based on the income statement, at what point are you breaking even? And the way it works is we take sales, so sales amount, minus variable cost. Sales minus variable cost equals contribution margin. minus fixed costs equals income. When income is 0, you've broken even. So here we go. Sales is always at the top of the income statement. You know that. That's your revenue, your sales. Minus cost of goods sold. Cost of goods sold includes some fixed cost and some variable costs. You know that. Direct materials, direct labor, factory overhead. That's cost of goods sold. Yeah. Sales minus cost of goods sold equals gross profit. Minus selling administrative expenses equals net income. When your net income equals 0, that means you've broken even. So sales minus variable costs equals contribution margin minus fixed costs equals net income. So if I look at this example, sales 80,000 minus variable costs 56,000. How we got 56? Remember the original example. My sales price was $100 a unit. If I sell 800 units, it's $80,000 in sales. My variable cost was $70 per unit, which means my contribution margin per unit is $30. So sales minus variable cost, 800 times 70 is 56,000. Sales minus variable costs equals contribution margin. Contribution margin, 24,000. How do we know 24,000? We sold 800 units at $30 contribution margin per unit. 100 minus 70 is 30. 24,000 contribution margin. My fixed costs are 24,000. 24,000 minus 24,000 is 0. So when you hit the point of 0 for your net income, you've broken even. So this is the second method to be able to tell when you've reached the point of break even. It's a good method. Don't get me wrong, I like it. I prefer the formula method. The last method to find the point where you've broken even is called the cost volume profit chart. Cost volume profit chart. It's a graphical representation. Here's what it looks like. I know, right? Okay, it's just a graphical representation. Now, we see our total sales line in green. We see our total costs on the red line. We see the profit area. We see the loss area. Based off of the previous methods, I could figure out the point of break even. The point of break even is where your total sales equals your total cost. Pretty straightforward. We see that's where they intersect. Total sales equals total cost. And they intersect $80,000 in sales and 800 units production. Cost volume profit chart. If you sell below break even, you're losing. If you sell above break even, you're profiting. That's the chart. It's a nice chart. It's okay. Not my favorite. Prefer the formula method. Now, one of the other reasons why finding your break-even point is so critical is because you should be able to estimate what will happen when there's a change. In other words, what happens when I change my sales price? What happens when I change my sales price? If I say, hey, you know what? My sales price was $100. I'm going to put it on sale. What happens? in this example, my sales price is $105, and at $105, my variable cost per unit is 78. My total fixed cost is 21,000. But you know what? Recently, I decided, oh, I'm going to reduce my sales price by $5, bring it down to 100, which means my variable cost is 70. My total fixed cost 24,000. We can see the impact of these changes, and so that's why understanding the formula is so important, right? Because it will tell us the changes that need to happen if I change my sales price. If I bring my sales price down from 100 down to $90, how much? That obviously means I need to sell more units to break even. If I raise my sales price from $100 to $105, I can sell less to break even. That's the point of this. As it says, okay, if there's a change in the sales price, that means your point of break even also must change. So, this one is called a margin of safety. I like this one. The reason why they call it a margin of safety is because it represents a safe level of sales. I feel safe. I feel safe when I'm doing better than break even. I feel safe when I'm doing better than break even. Margin of safety. Margin of safety. Okay. I feel safe when I sell more than break even. So here's how it works. I take the expected sales, that's how much I expect to sell, minus my break-even sales, the point of break-even in terms of sales dollars. So expected sales, $100 or 100,000, minus break-even of sales dollars, 80,000, divided by expected sales, 100,000. That gets me 20,000 divided by 100 is 20%. My margin of safety is 20%. That's how much I need to sell 20% margin of safety to feel good about covering all of my expenses, my costs. Another method is called, another application, I should say, of applying break-even is called computing income from sales and costs. This is very similar to your contribution margin using the income statement method. We take sales minus variable costs equals contribution margin minus fixed costs equals net income. When your net income is zero, that means you broke even. Now, if I apply the margin of safety here, meaning I'm selling above 20%, about 20% above, then that should be reflected in my net income. So in this example below, we see sales minus variable cost equals contribution margin minus fixed cost equals net income. We see that in before taxes and after taxes, we see that in both of these examples, we have done better than breaking even. Oh, another one. This one's nice. I like this one. The target income. I think we talked about this briefly. Was it last week, week before? We talked a little bit about target income. Target income is the amount of profit I want to have. That's the amount of profit I want. I want to have profit. That's called my target income. Okay? So the amount of sales, income I want to have. Target income. To find the target income in terms of sales dollars, I take fixed costs plus the target income divided by the contribution margin ratio. Remember, contribution margin ratio is your contribution margin per unit divided by the sales price per unit. So contribution margin ratio, $30 divided by $100, 30%. So I take fixed cost, 24,000 plus my target income, 12,000. I want to end my month with $12,000 net income. Yeah? So that's my target income, 24,000 plus 12,000 divided by contribution margin ratio of 30%. That means I need to sell $120,000 of sales in order to attain a net income of $12,000. That's nice when you're setting goals, when you're setting sales goals in your business. We can figure that out from the number of units I need to sell as well, just by simply taking, instead of contribution margin ratio, you can do it by measuring the contribution margin per unit. We take fixed cost, 24,000 plus targeting income, 12,000 divided by contribution margin per unit of $30 equals 1,200 units I need to sell in order to attain the target net income of $12,000. Remember, the target income is like, that's your goal. That's how much net income you want to have at the end of the month. Target. It's your goal. And another way of calculating your target income, whether from sales, take sales minus variable cost equals contribution margin minus fixed cost equals your target income. You can find your target contribution margin by taking your fixed cost plus your target income. That way you can find your sales by working backward. Your break even will change over time because your sales will change over time, right? But your break even will change over time if there's like a change in the contribution margin based off of changes in your sales price. Like going back to our example, if I instead of selling it for $100 a unit, if I change that sales price, that will change my break even point. So here's how we look at a revised or changed break-even point in terms of sales dollars. I take my revised fixed cost divided by my revised contribution margin ratio. 30,000 divided by 40%, $75,000. That's what I need to sell to break even in this new version. And you can do the same exact thing using revised break even in terms of number of units. You can take revised fixed cost divided by your contribution margin per unit. And that will give you your revised number of units you need to sell. Just remember that, when there's a change in the sales price, you're going to need to revise your break-even point. So, and sometimes in business, our business, we might decide, hey, you know what, we're going to sell different products. Instead of just selling, hey, the same product over and over and over again, I'm going to add some different products into my sales mix. When I do something like that, of course, I will need to revise my break-even strategy because now I have multiple products. When I have multiple products, that means I have different variable costs for each product, right? So oftentimes what we do with respect to sales mix is we take all of our different types of products into consideration in developing a break-even strategy. I'm going to add up all of my variable costs for units, and, providing, and all that good stuff to figure out the volumes. Here's what that looks like. So I take my fixed cost and I divide that by the contribution margin per composite unit. A composite unit is we took all of our individual products that we're selling, we found the contribution margins, we added them all up and divided by the number of units that we're selling. Composite. Yeah? Think about like we're expanding outward. Here's an example. This is a hair salon. Okay. Hair salon. We offer 3 cuts of hair. We have basic, budget, basic, and ultra. Ooh, ultra. That's cute. Okay, so basic haircut, budget haircut, basic haircut, and ultra. So I have 3 different types of haircuts. Yep. My sales price and my variable cost are different for each type of haircut. So I take my sales price minus my variable cost to find my unit contribution for each type of haircut. And I can find the sales mix ratio based on the contribution margin for each type of haircut. Then what I do is I take my sales price minus my sales mix ratio, or I'm sorry, times my sales mix ratio to get my sales price per haircut. And I add all these together to get my total sales price per composite unit. So take your sales price per composite unit minus your variable cost per composite unit to get my contribution margin per composite unit. Basically all we're doing is we're just adding in different products. With multiple products comes multiple points of break even per product, right? But we can simply add all of them together to get the composite units to find the total number of haircuts, for example, I need to provide in order to break even. So we've got fixed cost divided by contribution margin per composite unit to get the number of haircuts I need to make to break even. So fixed cost divided by contribution margin per composite unit, find how many haircuts I need to provide to break even. Remember, composites is a composition of all of the different products that we offer. And here's a look at this again. So sales mix times number of composite haircuts gives me the number of haircuts of each type of unit. Add all those up to be able to get the total number of haircuts. It's an interesting method. Sales price times number of haircuts, where you get the total contribution margin for each type of haircut, and of course our total contribution margin, as long as it equals our total fixed costs, we have broken even. couple of assumptions here. The sales mix is constant, meaning I'm not continuously adding or subtracting different products. We sell each type of unit. The costs are relatively linear, and they can be classified as either being fixed or variable costs. Those are the assumptions that we make when we're doing that type of analysis with multiple products. Understanding the change is important because it affects what we call the degree of leverage. Leverage is kind of like saying buying power. It provides you with operating leverage. Yeah. We do this to measure the fixed costs as they're being used within the organization. It tells me how well I'm utilizing my fixed costs. And it can be expressed as either a percentage of sales that will affect profits. And the degree of leverage, we take total contribution margin, in terms of dollars, and we divide that by our pre-tax income. Pre-tax income, or income before taxes. Somehow this amount it reads. And in this case, our degree of leverage is 3, which is pretty good. Anything above 1 is good. We can find operating leverage by looking at, again, total contribution margin divided by pre-tax income. Sales minus variable costs equals contribution margin minus fixed costs equals pre-tax income. So I take total contribution margin divided by pre-tax income to get the degree of operating leverage. And of course, we express that through percentage by taking the degree of operating leverage times the change in sales percentage, in this case 10%, get 30%. And I am not going to even bother with this one, but the least squares regression, this is more statistics, and this is another method that you could use to find break even. Yeah, that's not for me. That is not something that I would do realistically for a client or in real life. That's just me. Remember, I don't like statistics, so that's just me saying that. And it's also important to understand, as we're talking about all this, the contribution margin with respect to the variable cost income statement. Variable cost show that the change in the total changes in production levels are included in product costs. So as your level of output changes, your product cost will change to some degree. Remember that the variable costs include direct materials, direct labor, and variable factory overhead. Fixed overhead costs are excluded from product costs, like the supervisor's salaries, etc. Those are classified as fixed factory overhead. This is an example of that. Any questions? Questions, comments, concerns?
No.
You good? All right.
Yeah, we good. Well, actually, like I said, everything you just did, we just did this last week.
Yeah.
I do have a question.
Yes, Kayla.
Not about the chapter, but for future references for
Sure.
our first test. I just wanted to know, like, are we going to receive a study guide for like specifics that's going to be exactly on the test?
Yeah. So next week, on Tuesday at 11, I will discuss what will be on the midterm exam. So that way you'll know what to study for. So the short answer is there's not like a printed guide or something like that. It's just conversation. Because the exam will cover chapters 17, 18, 19, 20, and 21. So basically everything we've covered since the start of the course. It's 20 questions, a mix of true, false, multiple choice. On average, there are 2 questions per chapter. So we'll talk more about that next week. Good question.
Once you tell us like this, not the study guide, but once you tell us when to be on a test and we, have opportunity to go over that, will we have like a review class type of day?
That's what we're doing next week. It's kind
Okay.
of like a review class. Yep.
Okay.
Yeah, great question. Are there any other comments, questions, or concerns? Y'all did. Okay. Let me show you this real quick. This week, by Sunday night, chapter 21 homework. Remember, 2 attempts, open book, open note, true, false, multiple choice, just like they had been. That's due this Sunday night. Please try not to be late with any of your work, because, as you know, this course requires something each week. Yeah.
Oh, and Professor, I did email you. I emailed you about the chapter 19 homework like
Yep, I
a long
got
time
your email
ago.
on that. So, yep, just try to make sure that you get that in when you can. Yep. Okay. Okay. If there is no other comments, questions, or concerns, as always, I want you to remember that I am here for you 100% of the time. You can email me, call me, set up office hours. We also have tutoring. For those of you who are ever interested in tutoring with Dr. Remy, he has tutoring. It's right there at the top of the course, of the content, tutoring. So there's tutoring. You can email me, call me, set up office hours, whatever it takes. We're here for you all the time. And with that, I want you to please remember to stay safe. Wash your hands. It's a virus thing going around. Wash your hands. Stay safe. Wash your hands. Do the right things. And I'll see you all again, same time, same channel next week, 11 o'clock on Thursday. Have a wonderful, wonderful, wonderful rest of your day. Thank you all so much for your time. Take care. Bye.